contingent liabilities from Chapter 11. Contingent liabilities could become a current liability and require a recording. Looking at your book's definition of a contingent liability, a potential rather than an actual liability, because it depends on a future event. So let's look at the features or milestones of a contingent liability. First of all, there is a past event. Secondly, there is a possible future event related to it. And finally, a potential future payment because of that follow-on event. The key is this possible future event, the related event, will it result in a need for a current liability journal entry? That's the key question. As an example, someone at your eating establishment drinks some coffee and it's very hot and they burn themselves. The next possible future event related, they bring a lawsuit against you for that hot coffee. And finally, is that lawsuit, what's the potential for future payment? This is the case of, this has to be evaluated to determine whether a liability is recorded or not. That the contingent follow-on event to a past event has a probability of resulting in a future payment, which may result in the recording of a current liability now. Here's a chart that catalogs the future probabilities that may relate to the recording of a current liability. If it's probable that that related event, that lawsuit, will result in a future payment, it must be accrued currently. If it's probable that that related event will result in a payment, but it can't be quantified, it can't be properly estimated, it'll only be footnoted. If the follow-on event, the lawsuit, is only a reasonable possibility of future payment, in other words, that the suit will be won in court by the plaintiff, it only requires to be footnoted. And if the probability is remote that that lawsuit will result in future payment, it can be ignored, no journal whatsoever. So the various levels are either it's accrued in the books, it's booked, or it's only footnoted, or it's ignored completely, not recorded in the journal entry, not even footnoted in the financial statements. So if it's probable that that follow-on event, that lawsuit, will succeed, a journal would be entered in the books, debit expense, in this case, hot coffee incident, and accrued liability for future lawsuit. So establishing a liability and recording the expense now because it may be deemed probable that that lawsuit will succeed. Again, only if reasonably possible, it only be footnoted. This journal entry would not be made, only a footnote in the financial statements, and if the lawsuit is has a very remote chance of succeeding, does not have to be recorded, does not have to be footnoted, it can be ignored as concerns financial accounting. Page 611 in your book gives you that same chart. Again, if the lawsuit success is remote, there's no disclosure required. Reasonably possible, the company would describe the situation in a footnote to its financial statements. If it's probable and the amount cannot be estimated, we would also put it in a footnote. But if it's both probable and the amount of expense can be estimated, that contingent liability becomes an actual liability and must be recorded as an expense and a liability in the books of the company. It's all about ethical fairness to stockholders and others interested in the conditions of the business as to whether it should be reported or not.